Hello investors and future investors, welcome to the channel. For today's video, I'll be showing you how to trade United Health. I'm going to show you a simple option strategy that can make you have almost zero risk. Yes, I said it, almost zero risk. And in addition to that, I'm going to show you how to use United Health right now in order to make consistent income. Now, if you're new to options trading, or you're trying to use options in order to make some additional income to supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be showing you once again how to trade United Health. United Health is in the healthcare sector, and it is one of the biggest within its sector. Now, it's been in the news for the last 3 months. What I'm going to do for today's video is that I'm going to show you the actual technicals, the fundamentals of the stock, and I'm going to go ahead and show you how to trade this stock. Now, the share price is at $303 per share, so I know most of you guys that watch my channel have small accounts portfolio, so do not fear. I will show you option strategies that can be utilized if you're trading with a small account portfolio. Now you guys know how we do it. Let's go ahead and get down and dirty with options. Now, before I continue, I want to let you guys know the only proven way to learn options is by practice, practice, practice. So it doesn't matter how many videos you look at, how many books you read, you need to actually go ahead and practice these option strategies. That's how you're going to get good. That is how you're going to get consistent. Now, to start off the video, we're going to go ahead and go to the advanced feature right here in order to open up United Health chart. Now we're going to go to the 1 year outlook to see how this is doing. Now, I did make a video about this about a month and a half ago, and thus far I will show you that nothing changed. Stuff have changed pretty much, but it has stayed the same. So we're going to start off as usual with our blue line, which is representative of our 200-day moving average. The share price for the 200-day moving average is about $443. So what this is saying, for the past 6 months, the average cost of the share price has been around $443. Currently, we're sitting at a share price of $303.50. Now, that price of $303.50 is below the 200-day moving average. So if this share price decides to go up, there's a very high possibility it's going to keep going up until it gets to around the $443, $450 range. Now, this might take some time, but it's going to get back to the 200-day moving average. The stocks always do. Now, the one thing I want to bring to your attention is this right here. If you put a line right here, you're going to see what's known as a support. United Health has showcased a very strong support at a $300 price. Now, the last video I made, I showcased this 300 level of support. The reason why it's such a strong level of support is that you can see the chart has touched this line several times throughout the last, I think, 3 months. The first time was, I think, May 13th. So it's been 3 months. This stock has been trading around the $300 mark. Now, I want to show you guys another thing. The other thing I want to show you guys is that the peaks that this stock has had. It has one peak right here, and that peak, actually, you can't see the price right now. I'll show you the price on the other chart. Now, let's go ahead and go and check out the RSI, which is down here, the Relative Strength Index. Now, from the previous video I made, the RSI is still smack right where it was, right around the 50 RSI. So it's pretty much still in neutral territory. Now, with the share price trading at $303 below the 200-day moving average, now we could go ahead and make a decision of what option strategies we want to use on this stock. So let's go ahead and we're going to go back to the stock outlook. One thing I want to show you, let's go ahead to the year-to-date mark, and I'm going to show you. So this is what I wanted to highlight right here. Throughout the last 3 months that this stock has been trading around the $300 range, it has made a few peaks. One of the peaks is right here at $321. Another time it peaked was right here at $318.50, and even the third time it peaked was right here around $326. I have been trading this stock a lot, so I know a lot about the stock so far. So remember those peaks, it will come in handy as we continue with this video. Now, I myself has decided to do one strategy with United Health, and that strategy is known as DCA, or dollar cost average. Dollar cost average simply means that you allocate a certain amount of money to the stock on a weekly or monthly basis. You just sell it, you just forget it. Exit strategy. My exit strategy for this DCA strategy is gonna be whenever the share price gets to 375 to 400, between that range, then I'm gonna go ahead and sell my actual shares, and then I'm gonna lock in my investment gains, and that's it. But you guys know on this channel I'm mainly focused on options, so I'm gonna show you the option strategy that I'm currently doing. Now, before we do that, let's go ahead. I want to bring one more thing to your attention, and you're gonna get that if you go ahead and go to the trading trends. Now, with the trading trends right now, if we go to the hedge funds, you're going to see there's a huge spike right here. Now, this huge spike right here can be misleading. The reason why it has this huge spike is because a few investors, billionaire investors, decided to go ahead and buy into the stock. Mainly, it was one Warren Buffett, which you guys should know as the Oracle of Omaha. So they put so much money into the stock that they decide to have this spike here. The reason why they decide to invest into the stock is because at the current price, they think that United Health is at a very good value based on the stock actual fair value. So they think they're getting a good deal by buying at these prices. What they're going to do, since they have it in their portfolio, they have a 5-year to 10-year outlook. They're going to wait until the share price appreciates, and then they're going to get out of the stock. So if you're going to go ahead and do that route, be prepared to hold a stock for minimum at least 5 years. Now, there's one more thing I want to show you, and that's going to be the fair value. Since the last time I made this video, the actual fair value was at $473. Now, 2 months later, they actually reduced the fair value to $400. This is still good. The reason why it's still good, the current price is trading around $300. The fair value is $400, which means if the price moves from the $300 to the $400 mark, that's upwards of a 30% increase. So even if you decide to just get stocks alone and DCA into the stocks, you will also make some decent money. But let's get down to why you guys are here, and that's for the options. So let's go ahead to trade UNH options right here in order for us to open up the options chain. Now, for those of you new to the channel and those of you new to options trading, this down here is known as the option chain. And what the option chain does is that it gives us so much information down here which we can use in order to make an informed decision before getting into any option contract. Speaking of option contract, I want you guys to do yourself 2 favors. Favor number 1, always make sure to go ahead and do your own due diligence before investing. What may work for my portfolio may not work for yours. The second favor that you need to do yourself is going to be always make sure to have an exit strategy before entering any option contract. That way, if the stock decides to go against you, then at least you know how to get out of the trade. And I will be showing you another exit strategy for this option. So what we're going to do now, we're going to go ahead to buy, we're going to go ahead to call, and we're going to go ahead and choose our strike date. The strike date I will be going with is going to be September 18th, 2026, and that's going to give me 393 days to expiration. This is going to be known as a leaps option. The reason why it's going to be known as a leaps option is because my expiration is going to be more than 365 days, or rather more than 1 year. Now, all a leaps is, it's a long call that goes beyond a year. So the strike price I will be going with, remember, you go to buy, you go to call, you select your leaps strike date. Now, the strike price I will be going with is going to be obviously the $300 strike price. And we just showcased that the $300 strike price has an extremely strong support. Can the share price go below $300? It absolutely can. As you saw on the chart, it did go down to around 243. It came right back up. Can the share price go above the $300? It most definitely can. It goes up and it comes back down. I show you the 3 spikes. Now, what that is actually called a consolidation. It's trading at that range for the longest while. It's actually consolidating. What comes after consolidation is going to be a breakout in either direction, either to the top side or to the downside, but it's going to break out sooner or later. Now, I don't want to get into that right now. We're just going to focus on the options. So because we're going to be doing a buy call, we're going to have to pay for that. The amount we're going to have to pay for that is going to be $50.45. Let's go ahead and click into that strike price. As you can see here, a long call. So a leaps option is simply a long call that goes beyond a year, beyond 365 days. For those of you who have never heard the term LEAPS option before, it's a simple acronym that stands for Long-Term Equity Anticipation Securities. Hence, we just say LEAPS. Now, what I'm going to show you is that I'm going to show you how to minimize your risk to almost zero. So the amount of money you're going to pay for this is going to be $5,045. And that's because each option contract contains 100 shares. So you simply multiply your 50.45 by 100 shares in your one contract you're going to purchase, and that's going to be $5,045. Now that you have a LEAPS option in your portfolio, now I'm going to go ahead and show you how to make consistent income with that LEAPS option. The reason why anyone would want to get a LEAPS option is because if you're trading with a small account portfolio and you want to do options with this, you're going to need to either control 100 shares of a stock or buy 100 shares of stock outright. If you're trading with a small account portfolio, you most definitely would not be able to buy 100 shares outright. 100 shares outright was going to cost you around $30,000. Now, by utilizing the LEAPS option, you're now able to control 100 shares for only $5,045, which is a fraction of the cost if you were to buy it outright. So, if you are trading with a small account portfolio, this is going to work out perfect for you. Now that you have the LEAPS option in your portfolio, what are you going to do with it? Now, if you guys are getting any value from this video, please go ahead, like the video, subscribe to the channel. Make sure you hit the notification bell to get an alert. I usually post these videos every single week. We are trying to get to the 3,000 subscriber mark, so it would do me a good solid if you guys were to go ahead and subscribe to the channel. Now, let's go ahead. I'm going to show you how to make consistent income. Now that you have the LEAPS option in your portfolio, you're going to go ahead and use that as collateral. And we're going to be using the collateral in order to sell covered calls. And this is where I'm going to show you how to zero out your risk. We're going to go to sell. We're going to go to call, and we're going to be choosing an expiration date. We're going to be doing monthly expiration dates. So let's go with September 19th, which gives us around 29 days, close enough to 30 days. Now, how are you choosing your strike price? Well, first of all, you're going to need to choose your strike price above the current share price. But the basis I would use personally, remember, these videos are based on what I am doing with my personal portfolio. So now that I have spent $5,045 on the LEAPS option, I want to make that money back. Don't matter if the stock price goes up or it goes down. What I'm going to do, I'm going to divide my $5,045 by 12 months. That should give you around $400. Let's just average it to $400. So what I'm going to be trying to do is make $400 premium on a monthly basis. If I go ahead and do that, I should be able to make my $5,045 back despite what the share price does for those 12 months. So I'm going to go ahead and choose a strike price based on that, based on me wanting to make at least $400. So we're going to go with the strike price of, okay, so here's the dilemma. I can go with the 325 strike price, and that's going to pay me $4.55, which is going to equate to $455 in the real world. However, I just showed you the three spikes that this stock has had for the past 3 months. One came close to about $326. So what I'm going to do, because I'm an ultra conservative trader and investor, I'm going to want to give myself a little more wiggle room. So what I'm going to do, I'm going to go to the next strike price up, which is going to be the $330 mark. Now, with the $330 strike price, you're still getting close to $400. So that's perfectly fine. Whenever the share price goes down, your premium is going to go down. Whenever the share price goes up, your premium is going to go up. So you will average out around $400. So do not try to rush the trade. Do not try to always lock in the exact same amount. That's just going to put unnecessary pressure on you in order for you to meet your goals. So let's go ahead. We're going to select that. So there you have it. Now, I'm going to be using the LEAPS option I just purchased in my portfolio for $5,045. I'm going to go ahead and sell monthly covered calls in order to acquire a premium of around $400. If I am able to do that for 12 months, then I should be able to make back the amount of money I spent on the LEAPS option. Now, that is just basic for consistent income. Now, you're going to be making some additional money. Let's say United Health now decides to go ahead and appreciate in value. What's going to happen is that every time the share price goes higher than this, then your LEAPS option is going to be up. That amount of money that your leaps option is going to keep going up is going to be known as your return on investment, or what I like to call on this channel, your investment gains. So you're going to be making sure money in order for you to retrieve your $5,000. In addition to that, you just need to make sure you keep the leaps in your portfolio in order for the share price to go up, and then you could go ahead and close this out and Bob's your uncle. Now, exit strategy. Come expiration date, this is just for the sell call or the covered call. Come expiration date of September 19th, ideally, what you want to do is that you want to make sure that this share price is always below whatever price you choose here. In this case, you want it to be below 330. If that happens, then you keep your $365. That $365 is always going to be consistent income that you get to keep in your portfolio. Now you keep your $365, and now you're going to have your leaps option released back to you. Then you could go ahead and rinse, repeat this strategy, and be consistent. Now, the other way this trade could go, come expiration date of September 19th, if this share price happens to blow past this $330 right here, then you're going to be in danger of losing your leaps option. So whenever you're choosing your strike price, always try to make sure you choose your strike price as high as possible in order to minimize the chance of you losing the leaps. But exit strategy. If the share price does go above the $330, then you could do another option strategy, which is going to be known as rolling. So you're simply going to roll this strike price. And I don't want to make this video too confusing or too long, but based on what the stock market is giving you, you could roll the 330 up and out, or if the stock goes down tremendously, you could roll it out and down. Rolling is another topic of itself. If you guys are interested in seeing how to roll options, go ahead and just search the channel for options rolling. Now, I'll leave you with this key tip. Whenever you're going to be rolling your option, always make sure you roll for a credit. If you do have to pay a debit in order to roll the options, just let the options expire. Now, let me show you another exit strategy. If the share price does go past your 330 here and your leaps are in danger of being assigned, do not worry. Let me show you why you don't worry. You're still going to be making money. In addition to this money you get to keep, you're going to be making the difference between your 330 here and your 303 right here. So that's going to be around $27. Now we are dealing with options here. So you're going to multiply your $27 by 100 shares, and you're going to be receiving around $2,700. That is if everything else remains equal. Now, I did blow past this, but whenever you buy your leaps option for September 19th, you do have what's called a break even, meaning you should always try not to sell any strike prices below your break even. Your break even was, if I remember correctly, it was $350. So if you do lose around here, you could always go ahead and try to roll the options up to the $350. So what that's going to do is that you're going to make back the exact same amount of money you spent to get the leaps, which is $5,045. And in addition to that, you get to keep all the premium that you receive. And that, investors and future investors, is how you trade United Health in order for you to make consistent income and have almost zero risk. Now, as a reminder, these videos are simply for education and entertainment purposes only, and they're simply reflective of what I'm doing with my personal portfolio. Always make sure to do your own due diligence before investing. Now, if you guys have any questions about any option strategy we featured today, or you guys are looking to start a brand new portfolio, then check out the links in the description below. I'd like nothing better than to help you grow your small accounts portfolio. Now, for those of you that made it to the end of the video, you guys are the real investor and future investors. If you haven't already, now would be the perfect opportunity for you to go ahead and like the video, subscribe to the channel. Let's help us get to that 3,000 subscriber count. Now, here's the most important thing, right? I do put out this content in order to help as many people as I can grow a small account portfolio by making consistent income. If you guys know anyone out there struggling to grow a small account portfolio and you think this video could help them, then the right thing to do is to go ahead and share this video with them. Together, let's help as many as we can make income from options trading. Now, until the next video, keep pushing your investments.